program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863.
Hi, I'm Joseph Gomez-Tagle, a professor of economics and a community advocate. I've been working to reform tax laws for decades, earning me the nickname Joe Taxes. In 2002, I walked over 150 miles to my state's capital to send a message to the legislators about tax reform. Was it the most logical thing to do? Maybe not, but some problems can't be solved with pure logic alone. Many of the economic issues facing our country, from the federal budget all the way to the household budget, are too complicated for a single solution. From the outside, many people view economics as a science of numbers, graphs, and charts. But economics is really the study of how we use what we have to acquire the things we want and need. Understanding human behavior is the key to understanding economics. To study how people behave on a large scale, researchers first assumed that people mostly behave the same way and that they all share the same priorities and concerns. In the real world, however, we know this is rarely, if ever, true. Emotions, values, and past experience often have as much to do with determining our behavior as logic and reasoning. Whether you are shopping for new clothes or a new home, emotions certainly part of the transaction. The messy, illogical actions of real human consumers and investors has led to the creation of a field known as behavioral finance. But why does all this academic study of finance matter to you? Because whether you're investing $5 million or your first $500, the outcome will be influenced by your behavior. We hope that by examining how and why we make financial decisions, you can gain a better understanding of your own finances and make smarter decisions in the future. So stay tuned as Money Sense tackles the irrational world of behavioral finance.
Welcome to this episode of Money Sense. I'm your host, Anthony Contrucci. This week we'll be discussing behavioral finance with two experts from the investment industry. Rick Milton is Managing Director of MainStreet Advisors, located in Chicago, and a chartered financial analyst for more than 20 years. Tim Rice is a partner and president of Lakeside Wealth Management. He has nearly 2 decades of experience and specializes in qualified plan design and consulting. Tim, Rick, thanks for joining me today.
Thanks for having us.
Thank you.
I'm really excited about this topic. A saying I've heard used countless times is, the game of investing is not that game where the individual with the higher IQ beats out the person with the lower IQ. And what I've heard in the past is that typically the person who wins is someone that's utilizing rational thought, right, is consistent and disciplined. And so a lot of that has to do with kind of the psychology of investing and behavioral finance. So my first question to Rick is, what is this term I've heard countless times, behavioral finance?
Sure. So you mentioned rational thought, and unfortunately rational thought exercises our brains a little bit more than we want to use our brains. We want to use our intuitive minds a lot more. When I ask you what 2 + 2 is, you don't have to rationally think about anything. It just comes to mind. So we find that our brains oftentimes are lazy. And how do our lazy portions of our brain make us choose uncharacteristic investment decisions, things that might not benefit our portfolios and our money and our decisions? So behavioral finance tries to take a look at some of those lazy thought processes and how it affects the growth of our money.
So it sounds like, what I'm hearing at least, is that our mind, potentially our bodies, are kind of structured in a way that they want to be efficient. So again, you're going to default to things that maybe you feel more comfortable with, or things that you know. So again, 2 plus 2 we know equals 4. Not a lot of thought has to go into that. Not a lot of energy or brain power. And so when it comes to investing, you typically just kind of gravitate towards maybe things that you know. Is that what I'm hearing?
Absolutely. And the fact is we can't rewire our brains, right? We can't sometimes get past that just intuitive thinking or that lazy thinking. But it's just important to be aware of the fact that our minds do operate that way. And what can we do to overcome some of that action that we might not even realize we're making? Right,
knowledge is power, and if you recognize something, then you can change it. And if you don't recognize it, you can't, right?
Absolutely.
Wonderful. So, Tim, how does then behavioral finance come into play in the context of how we then invest our money?
Well, dovetailing on Rick's thoughts, think about the first couple weeks of October in the stock market. The equity market sold off 5 to 10% and then rebounded almost instantaneously. Sure. And it's amazing what that does to an investor's mind and psychology. The fear of loss is based on research, is twice as great as the feeling of earning money in the market. Investors tend to lose focus on the long term and focus on the short term when the market sells off like it did, and make irrational thoughts and behave in irrational ways. So one of the things that we find it's important is that people have to stay focused on the long term. They have to stay focused on the long term and realize that the natural ebb and flow of the market is not going to take out their long-term strategy, whatever that strategy is.
No, I agree 100%, and that's something we've kind of covered on previous episodes of Money Sense, is that the reality is when you're investing, it is that proverbial roller coaster to a degree, right? And sometimes a little bit crazier, peak to trough. Mm-hmm. But again, I think to your point, if you have that goal, if you know where you are today, where you want to be in the future, right? You have the roadmap of how you're going to get there. I think that tends to prompt you to stay on that roller coaster. Again, recognizing that maybe this month the market's doing really well, this month is doing really bad, but I'm still on track to achieving my long-term goals. Correct?
Absolutely, and there's such a thing as this behavior gap, and you talk about, there's been a lot of research, and I know Rick's very aware of this, is investment return versus investor return, and an investment any investment over the last 20 years might have achieved a 10% return, but many studies, the investor attained a 3 or 4% return, and it was because of that behavior gap and not focusing on the long term.
Mm-hmm. And I think we've seen that specifically, especially institutional money managers, so that professional money manager, this is their core competency, what they do every day, sure, versus maybe the individual kind of retail investor that maybe allows emotion to come to play a little more, and we'll get to that, I know, in some of the subsequent questions. Rick, what are some of the common mistakes? So now that we know what behavioral finance is, sure, we know how it may come into play with regards to how maybe our viewers are investing, right? What are some of these mistakes that you're seeing?
Sure. So I think I'll describe them and give examples of some of these mistakes that people are making. One common mistake that people make is stereotyping. Now, I know stereotyping has a negative connotation in our society, but the reality is that stereotyping is just an efficiency in which our brain handles information.
Kind of that lazy factor you're talking about earlier.
It's that lazy factor, right? So we know how a farm smells. We know the sound of a car engine, right? We don't have to process any information in order to make a decision within our brain. And a stereotype as it relates to investing might be the fact that someone goes to McDonald's and is treated poorly by the person behind the counter. That stereotype may continue for a lifetime, and it might mean that that person faced with a decision of investing in McDonald's may never ever invest in that company because of that stereotype. So that's a common behavioral mistake. Rationally, it could be a great company to invest in, right, but the stereotype holds true. Another example of a common behavioral mistake is just mental efficiency and mental shortcuts that we might take. An example of that is just because something is in the news doesn't mean it's investable. You know, you'd be absolutely surprised at the number of cash inflows into companies that are struggling or having some real problems. And for all the people out there who say, no, I wouldn't do that. I wouldn't invest in a company who might have done something wrong. I guess I would challenge all of those people to say, it is why politicians who are convicted and sentenced of a crime oftentimes are reelected, right?
The name recognition.
Name recognition, right? It's the idea that all news possibly is news, and even if it's bad. Another example of common behavioral mistake is a home field bias. We see this among doctors who invest in pharmaceutical companies, and that has some real detriment. While you might know your company, your industry, the concentration that could get created around you feeling like you know that industry could have a really detrimental impact if something happened to that company or industry. A steel worker who not only gets their income and derives their daily living from that company, but also invests in that company. And what happens if the price of steel goes down? Well, not only is their job at risk, but so is a good portion of their investable assets.
Almost over-concentrating.
Absolutely. Another area of behavioral mistakes is overconfidence. And overconfidence has been shown to lead towards frequency of trading. And a high frequency of trading has led to less and less results in the long term from an investment perspective. So Professor Gene Fama has a wonderful quote around this, and that is, your money is like a bar of soap. The more you handle it, the less you have of it. And I think that really resonates, that we really need to be focused on trading as infrequently as possible and looking towards the long term, as Tim has said.
Yeah, it's interesting you say that, because I think a lot of times, speaking of behavior and psychology, I think a lot of times people, they want to feel busy. I've seen that especially with with entrepreneurs sometimes, where I call it the running on the treadmill effect, where it's, and unfortunately in the world today, success does not come from being busy, from activity. Unfortunately, it comes from knowing where to spend your time. How do you triage your time and where you can be most impactful? So it sounds like you're saying the same thing with regards to investing, is do the due diligence up front, construct a sound portfolio, and then sit on your hands and let it do its job, as opposed to just constantly trading, right?
Absolutely.
Is that what you see as well?
Absolutely, and quite frankly, in today's environment, there's so many solutions out there to make this easier all the time. There's third-party money management resources in a company-sponsored plan. There's target date funds, 401k, asset allocation funds, and those things. And quite frankly, I'm in this business, and some of my money is in target date funds. People say, oh, I want you to manage this money, manage my money like you do your own. Well, I keep it simple. And over the long term, we find in many of our employer-sponsored plans that the folks that keep it simple, they get in a good asset allocation strategy or third-party money management solution or a target date fund, outperform that small percentage of the population that thinks they know how to invest. And just keeping it simple is one of the keys to making sure you get the return of the investment as opposed to that behavior gap return of the investor return.
Well, I think 100%. I think one of the things, I feel like we've almost been taught that to chase return. They call it sometimes in the industry, chasing alpha, chasing return. And I fundamentally disagree with that to a degree, because again, it's all about, it's like, for example, if I want to run a marathon tomorrow, okay, I want to run a marathon 6 months from now, I'm going to say, okay, this is where I am today, do a self-assessment, so I want to be 6 months from now, and now I have to, what's the roadmap to get there? Right? And so I think one of the things that we fail to do sometimes, whether it be the professional investor or the traditional retail investor, is we tend to just try to chase returns as opposed to saying, okay, I'm here today, I want to be here tomorrow. This is how much I can save, I can contribute to my future, and therefore you kind of back into a target return band or range. And that ultimately will dictate, I think, for them the products. The process dictates the products, and it shouldn't be the other way around. Yeah. Do you agree with that statement?
I agree. Yeah, I think that having that overall plan in place is one way to combat some of these behavioral biases that we just can't rewire within our brain. Sitting down and assessing what your goals are for your money and how you're going to get there is a key element of getting actually to that goal of running that marathon or anything else. I also think it's very important as people now have many different types of accounts. They'll have an account within a 401k or a 403b. They'll have a savings account, a checking account, an investment account. And what does that all look like when it's put together? What's the asset mix when it's all put together? Is something that I find people don't do enough of in the assessment of getting towards their goals.
So that asset allocation and also the asset position, kind of where that asset's actually being held from a tax efficiency standpoint, it sounds like, to a certain degree.
Absolutely, and I think that that leads to obviously a combatant of this diversification, which we can definitely talk about a little bit more as we go through this process.
So it sounds like one of the key ways of maybe combating some of these traditional behavioral finance pitfalls is having that plan and then working that plan. Are there some other things that maybe our viewers can do to kind of avoid some of these common mistakes?
Well, it's something I like to call tangible mental accounting. Creating separate buckets of money. Whether you're a retiree, somebody like myself continuing to accumulate for retirement, for a retiree, thinking about your needs, your wants, and your legacy. Your needs, that's your monthly income, your pension check, your Social Security check, and whatever income you're deriving from your investments. If you have that covered and that money is invested appropriately, then what's happened in the stock market the first couple weeks of October doesn't bother you because you have the consistency of your monthly income flow. And then your longer term investments, your wants and your legacy, that's where you're going to take on a little bit more risk in the market. But if you know your needs are taken care of, and if you've performed what I like to call tangible mental accounting, bucketizing your portfolios, then that's going to dramatically change the way you respond emotionally to what happens in the market.
Sure.
Great points. Yeah, no, it makes a lot of sense.
Yeah, I would say that, going back to that point of diversification, I think the one way that people could truly decide if they are diversified in their portfolio is to take a look at their assets and make sure you're always complaining about something. Really, if your portfolio is diversified, there will absolutely, positively be one asset class that you're complaining about, right? When the stock market was up 32% last year and commodities returned a negative 6%, I hope everybody was complaining about commodities. But there will come a time when the stock market may be negative and that commodity is providing that ballast or that diversification that you're looking for. So, just make sure that you're complaining about something and not just talking about the winners within your portfolio.
No, great points. One thing as people, I think our viewers know I'm very passionate about children and financial education, and so we're talking a lot about behavioral finance. How can maybe some of our viewers that are parents utilize some of these behavioral financial tools to really kind of teach and formulate the thought process of their children at an early age? Any ideas?
I have a couple. One is if you're doing something for your kids as far as investing for college or something, sit down and take the opportunity to explain that to them. I had the opportunity to do this with my 13-year-old a couple weeks ago, and it was amazing the conversations we had around the power of compounding, the power of systematic investing. I sat and explained why I had chosen the particular investments. Even went out and did some projections based on how much money we thought we would have saved and how much college that might cover. The other piece, and I know you've covered this in prior episodes, but a real simple thing that we've been doing with our kids for a number of years now, and I give this idea to clients all the time. But Anthony, is we have 3 envelopes, and we started out at, I think we started at $5, and we went to 10, and And we have them, we give it to them in $1 bills now, and they put it in the envelope. 60% to spend on whatever they want to spend on. 30% to save, and that accumulates, and then eventually they take it to the bank. And then 10% to give. And my kids have given to the church, they've given to the Boys and Girls Club. My son gave to a program to feed orphans in Haiti. And I know it's a version of your 3 cups, but it's a great idea, and it teaches kids the responsibility of investing and the importance of systematic investing, but also giving back. So I think that's a great idea. And the other is parents have to learn to talk to their kids about money. It starts at such an early age. We have such a financial literacy problem in our country. And the earlier we can talk to our kids, probably 10, 11, 12 years old, start talking to them about money. And perhaps the college savings is a way to do that.
No, I love it. Yeah, it's a way of, again, like you said earlier, kind of bucketizing your money to a degree and teaching them that at an early age.
Absolutely.
You might start trademarking bucketizing.
There you go. There you go. I like it. So we're talking about psychology, and so when you talk about demographics, and there's a term that people use nowadays, psychographics, right? How does maybe kind of where people are with regards to their journey in life? How does behavioral finance affect them?
We as humans, we love to put off everything until tomorrow, right? And that's honestly one of the biggest issues, is that the worker out of college or out of high school going into building trades, whatever it might be, they assume they're going to live forever and they can save tomorrow. Well, you know what? Tomorrow comes pretty fast, and you have to get started early. You have to do so in a systematic fashion. You have to take advantage of the benefit that employers provide you. So my advice to that young worker is, don't worry about becoming an investment expert. Go into a managed solution like a target date fund, a third-party money manager, or a target risk fund, and take advantage of the employer match. If the employer's matching dollar for dollar on 6%, put in 6%. If you start early, you will not miss it. You just achieved 100% rate of return. Did your portfolios earn 100% last year?
They did not.
They did not. Mine didn't either. But if you get involved in an employer plan, you can most likely earn that kind of return on that money right away. And the best thing that ever happened to me when I was 22 years old, my first boss sat down and said, I can't make you do this, but put 10% of your pay in the 401k. And after 3 years, I looked back and I thought, I didn't miss any of this. And I had a year's salary saved already. That's really amazing. And the quickest way, everybody wants to be the proverbial millionaire. The quickest way is starting early.
Yep, starting early and saving often.
Absolutely.
Right?
Absolutely.
We say that a lot. So we've talked again, we understand, I think, behavioral finance and some of these common mistakes and maybe how to start to avoid these. How can a professional money manager, working with that professional money manager, help an investor?
Sure. I think it takes some of the emotion out of it. I think that a manager, a professional money manager, is not going to have that home field bias. They're not going to allow a portfolio to be invested in one particular industry or one particular company. Managers are also very good at looking at the long term and helping you create that plan and sitting down and doing those meetings and constantly reassessing, are you meeting the goals along the way? It takes a very disciplined person to do that on your own. Some of us need that little push in order to keep us on our path. So I do think that professionals can help in that manner.
And I'd actually add to that, Anthony, that in addition to professional money manager, engaging an advisor or financial consultant on your behalf, it's an accountability partner. It's somebody to help you address those goals and figure out what your goals are. Most people don't even know where they need to be.
Right.
And have an accountability partner. Help you get to that plan. And in times like 2008, and in fact, I think last year, Rick, there were 3 distinct points. The S&P 500 was up, 32% last year. There were 3 distinct points in time where people thought the market was going to sell off dramatically. And it would have been very easy for an investor doing it on their own to get, let fear take over and exit their long-term strategy. And you know, it's just it's amazing how the mind, when the market isn't exactly going your way, will do dangerous things to you.
Right, yeah, following maybe your stomach versus your
Absolutely.
mind, or vice versa. Well, thank you guys so very much. I really enjoyed this. I know I learned a lot, and I'm sure our viewers did as well.
Thank you for having us.
Thanks for having us.
And thank you for joining us today. I hope you learned as much as I have. We look forward to seeing you next time for a new episode of Money Sense. I'm your host, Anthony Contrucci. And remember, we always try to make finance fun.
This program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863. This program was produced by Lakeshore Public Media and Centier Bank.